evening and welcome to the Money Show, the only daily show of its kind which brings you the market's top financial experts to answer all of your financial queries. I'm Avni Raja, but before we get started, here's a quick look at the headlines. 2017 has been a strong year for mutual fund flows. Mutual funds AUMs have increased 40% or more than 6 lakh crore over the past year, taking total AUMs above 23 lakh crore. Meanwhile, overall investor folios increased by 1.7 crore to cross 6.5 crores. Pension regulator PFRDA is examining ways to allow minors to open national pension schemes or NPS accounts. A decision on this could be taken as soon as the next few weeks. And terrific Tuesday on Dalal Street. Sensex shuts shop safely above the crucial 34,000 mark, while Nifty posts yet another record close of 10,530. Pharma and metals top the charts, while PSU banks lag. All right, first up, let's rewind a little bit as we're approaching the end of the year. As part of our year-ender tracking activity, let's take a look at what went down in the primary markets. Vivek Iyer joins us to wrap the action as far as IPOs are concerned. Vivek, 2017 has been quite a stellar year for the new listings. If you can just take us through the primary market activity and also give us a sense of the kind of performances that we've seen.
Well, if you're looking at 2017, you could actually call it the year of the IPOs. 2016 was actually, it raised almost a record amount of money as far as primary issues are concerned. But 2017 actually went one step further. And if you're looking at the kind of activity that we saw in the primary market, it became such a frenzy that a lot of market participants were actually calling it a bubble. But of course, let's analyze, what actually went right for most of the companies that listed this year and why they were able to raise the amount of money that they were able to raise at such high oversubscribed levels. Now, if we're talking about it, almost 37 companies listed in 2017. Most of these companies were actually offered for sale. Basically, this means that existing investors, private equity investors in most of these cases actually took an exit from the companies that they had or in their portfolio for almost a little over 10, 12 years. Now, if we're talking about some of the key companies to watch out for, Apex Frozen Foods, again, one of the companies that exports shrimp products to companies abroad, saw a stellar rally of almost 413% from the date of listing. Now, if you're looking at it, almost a 5x returns to the shareholders since the date was listed, and it got listed only in 2017. Now, of course, some of the reasons for the IPOs oversubscription as well as the stellar run-up has been the fact that HNIs are actually borrowing money from lenders at reduced interest rates, which is why you're actually seeing the kind of oversubscriptions. Also, FIIs have preferred to invest money into the IPO market, given the fact that valuations here are slightly more reasonable compared to the valuations on the main board. Now again, some of the main companies to watch out for, Shankara Building Products, almost 300% rally. Again, homegrown player. Avenue Supermarts, better known as D-Mart, one of the biggest and the best stellar outperformers as far as 2017's IPO is concerned. Remember, the company is present in the retail market.
Right.
And again, this is something that saw a stellar oversubscription and a stellar run-up.
All right, thanks Vivek for all those details. That's as far as the IPO market for 2017 is concerned. But 2017 has also been a very strong year for both mutual fund flows as well as performance of several mutual funds. But time now to also look ahead. And the big question now is, how should one go about choosing which mutual fund to invest in the new year? Well, here's Dhirendra Kumar with some of his recommendations for 2018. Take a look.
Being a regular investor actually benefits because you are able to average, and even if you have sizable large amount of money, large sum to invest, you should still spread it over a period of time. So consider your options, in small and mid cap fund. You have to really experience the market and the how important that money is in your overall scheme of things. That is so these are two crucial things besides how much you should always be investing your long term money. I think the coming year also is going to be very useful, and I think materially more rewarding for balanced fund investor, because the rebalancing that happens in balanced fund and the the ups and downs, the extreme volatility that we see in the interim, and the rebalancing that the balanced fund does will translate into superior. Be very conservative. Don't try to optimize your return or maximize your return on fixed income fund, because these investors, whenever they face a decline, it turns out to be extremely painful, and it's very difficult for them to reconcile with those 2% decline or 3% decline, as we are witnessing right now. Many investors bet with the dynamic bond fund, which look very disappointing. I think that equity is not correcting, and many investors have lost the opportunity by waiting, or endlessly waiting. But 1 year time frame, if you have only 1 year, then equity is ruled out. And generally speaking, I'm still optimistic about equity, and one has to be careful with the kind of funds you invest in.
Well, that was Dhirendra Kumar with his advice and some recommendations as far as 2018 is concerned. But let's now get to our guest who's joining us on the show today to answer all of your queries. Tanwir Alam, founder and CEO of Fincart.com, joins us on The Money Show. Thanks, Tanwir, very much for joining us. Pleasure to have you on the show. Well, since we're talking about forward planning and how to approach investing in 2018, I think, to start off, I'd like to ask you, as far as the new year is concerned and people who want to take that as a time to start planning, relook at their investment portfolio, if you can tell us some of the most common mistakes that investors tend to make that one should avoid really in the new year.
Okay, some of the common mistake that people make is, so let me first take you to a prelude of what are the basics of investments.
Right.
So when you're trying to create wealth, wealth gets created over a long-term period, and that is what we call as power of compounding. And power of compounding does not efficiently work for a time horizon less than 5 years. So hence, you should segregate your funds for which is long-term fund and what are the short-term funds. The short-term fund, the focus should be on protecting wealth and ensuring that you get a return which is better than the fixed deposit, the post-tax return. Now, if you have a longer-term fund, you can actually look at equity funds and grow your wealth. Unfortunately, one of the first mistakes that people make, which I have experienced, is they may have a very long-term money, but they try to put it for a very short-term period of 1 year, and they'll try to see how the fund works. So that is very detrimental to investing. Second thing which people do, in fact, which Dhirendra Kumar also covered, is that do not attempt to invest in equity fund or equity market for a 1 year period. That could be very fatal. If you are investing your long-term money, then only come in equity market. This could be the second common mistake that people do. The third common possibly mistake that people technically do is they have a high credit card or a personal loan, and yet they think of investing. First, they should think of settling those loans, high cost loans, before they start investing. The fourth mistake that typically people make is not have a goal map or roadmap for investing. So they should plan their investment, and more so retirement planning. If the sooner they start, the more money they will accumulate. Now, retirement planning, by virtue of being a goal which is very far away, tends to get neglected. But given the fact that you have inflation which is rising at a very high rapid cost, you need to start planning for your investment very soon. And the sooner you start, the more wealth you create. Third and more common mistake again that people do is some of them are afraid of investing, and they stick to the conventional investment products like fixed deposit and endowment policies. Now, those products may not work in this scenario. So I would like to state to them that the risk of not investing in that case will be much higher than the risk of investing. So this is the fifth thing people make a mistake. Sixth is they must have an emergency fund. This will help them to ensure that they do not destroy their long-term investment if there is some amount of emergency. The seventh thing would be to have a good online term insurance plan that works as an income replacement, just in case if you have any, if the breadwinner of the family is no more. Eighth would be buying a good health insurance and in adequate quantity. Okay. So because the healthcare cost, hospitalization cost is rising very rapidly in today's time. Fifth is not trying to time the market and ensuring that basically you have you rather spend time in the market than timing the market. Okay. So that is what I would say as the top 10 common mistake that people do, and one should stay away from that. And last and but not the least, stay away from anything that promises abnormally high return. For example, a Bitcoin or a chit fund. I would like to state that there is no free lunch available, and hence you should actually question where is the extra return coming from, what is the rationale, and if you are not convinced enough, please stay away from those bait which is given to you.
Absolutely, Tanvir. Extremely important points you're mentioning there. And even though they may sound quite simple for our viewers, it's extremely crucial to implement these points, and you will see a huge improvement in the kind of returns that your portfolio generates. All right, Tanvir, let's move on. We've got a lot of queries as well. Naveen Patel sends us this query. He says, I'm a retired businessman and have invested in HDFC Balanced Fund as well as ICICI Balanced Fund. Should I continue to invest in these funds for a period of 7 to 10 years? Tanvir, your response?
Okay. Both HDFC and ICICI Balanced Funds are very good balanced funds. And your second thing was that you want to stay invested for a period of 7 to 10 years. So the time horizon that you've chosen is also fairly good. So if you are investing for 7 to 10 years, you can stay invested in this fund, and they are very good fund. But however, I would like to just ask one thing out here. What I've seen are many of the current distributors are selling this particular balance fund with the bait that it will declare monthly dividend. And given the fact that you are retired, I hope you are not one of the victims to this bait. These balance funds have more than 65% in equity, and hence they are bound to be volatile, and there is no assurance of a monthly dividend payout from these schemes. For any reason, if the equity markets goes through a rough patch for a period of 1.5 years, the fund may not have surplus to pay out dividends to you. As per SEBI regulation, mutual fund schemes can only declare dividend out of booked profits, and hence in a market, when the market is correcting, there is no opportunity to book profit, and hence there is no certainty of that dividend. So my caution is, if you have invested hoping that you will get a monthly dividend, then you have to relook at your strategy.
Naveen Patel, that's the answer from Tanvir for you. Ensure that you remain invested for the long term, but these are not funds that will give you regular dividends as a guarantee. All right, shifting focus now, we've got a question coming in from Dr. Gill, who says, I'm a retired doctor, I have 40 lakh in fixed deposit that I want to invest in mutual funds and 30 lakh to invest in regular income. What do you advise? Which funds can I look at? Tanvir, not too many details as to, the time horizon, etc. that he's looking at really, but what would your advice be? Because there are quite big chunks that he's looking at.
Okay, I understand that one, he is retired, and two, he is looking at regular income, and yes, his disclosure is partial. We only know his financial assets, but we are not aware of his entire income, whether he is getting pensions or he has got rental income or any other source of income. But nevertheless, what I will try to suggest is an investment strategy which will help him get regular monthly income and yet ensure that his money lasts during his lifetime. Now, before I start my suggestion to him, one of the common mistakes that people do is invest very conservatively post-retirement. Yes, we have to be a little conservative, but what is one technical problem which is arising in today's time is that because of medical advancement, people are living a much longer life. The lifespan has gone up very rapidly. And what is happening? The inflation also parallelly has moved up very drastically. So inflation will, if you do not have a good investment strategy or a retirement for investing your retirement fund, then inflation will not allow you to live life peacefully, and medicine will not allow you to die. So that will be a big problem. So what you could do is, his 70 lakh he can break down into 3 buckets. One is less than 3 years, 3 to 7 years and 7 and above, because he will not require all the money at one go. So what I suggest, for his less than 3 year, he can invest in ICICI Income Opportunities Fund, which is like a bond fund. And in this bond fund, what he could do, he could trigger what is called a systematic withdrawal plan. It is nothing but an option that you choose to get a monthly payout from this particular fund. You can define the amount also. So this is a tax efficient way of withdrawing money. By this, he will not be paying a very high tax. The tax will be very nominal, and yet it will be much better return than a conventional fixed deposit that he chooses. The second investment that he could go for 3 to 7 years is Reliance Equity Savings Fund. This particular fund has a small portion of equity and the rest would be debt. But after a period of 1 year, the return whatever he gets will become tax efficient, means it will be completely tax free. Similarly, for a fund that is for more than 7 years, he can choose as ICICI Balance Advantage Fund. These two funds will help him to get anywhere between 8 and even 12% up also, Balance Advantage Fund. So the weighted average return on this portfolio will drastically go up.
Right.
And he could actually live a much longer, fund his retirement for a much longer time horizon of investment.
Right. All right. Thanks, Tanwir, for that answer as well. And Dr. Gill, those are the funds that Tanwir recommends that you could invest in. On that note, let's slip into a quick break. Lots more coming up on the other side. But meanwhile, do send in all your questions on personal finance and your financial portfolio. You can either mail us, you can call us, all the details on your screens, and we'll get them answered for you on The Money Show. Welcome back. You're watching The Money Show. And with us is Tanwir Alam to answer all of your financial queries. Well, Tanwir, before we go ahead to the next set of queries, while we're talking also, we've been talking about planning ahead for 2018. As far as selecting an equity broker or your broker really is concerned, help us briefly understand how should you go about doing that? What are the important things to ask the broker before you decide that this is the person who's going to be handling my money, advising me on what investments to make, etc.?
Okay, I will make it really simple. You can use the acronym as ACE, ACE. One is availability, C is competence, and the third is ethics. On availability, what he could do is basically the advisor should be available to him, and not necessarily the conventional way of meeting in person. If you find a good advisor who is available to you on call also, that might serve the purpose. But the person should be available to you to address your queries, should be patient enough to answer all your doubts, clear your doubts, and understand your requirement in person. That's one availability part. C is competence. He should have seen various market cycles, a good at least 2 cycles of bull and bear phases. He should have seen and should be able to help you navigate through those market cycles at ease, comfortably. And third thing comes on ethics, which is a very difficult part. So you need to ask him certain query when it comes to judging his trustworthiness. First of all, how does an advisor make money? Okay, that is one. And how we live the fiduciary responsibility of not being biased to a particular fund. 1. 2 is the product that he is suggesting. Each product has its return potential and also carries the degree of risk. He should be able to clearly explain that. Now, none of the products will ever be risk free. So it will carry some degree of risk, but the broker should be able to help you understand how will we navigate that risk, how will he mitigate or reduce that risk for you. That is one very important question one you should be able to ask. So summing up, how does he make money from to judge the ethics part? How does he reward himself? 2 is what is the risk and reward of a product? And third, if there is a risk and reward, how will he navigate you through that and how will he mitigate that risk, product risk?
All right.
So this is the three things that you should ask.
Right. All right. That's as far as how to go about selecting your financial advisor or your broker really for your investments. But our next question comes in from Vijay Kumar, who says that he's invested in Kotak Select Mid-Cap Fund. Should I continue to invest 4,000 rupees per month in this fund? Tanwir, I think there's some confusion here because it's either got to be Kotak Select Fund or Kotak Mid-Cap Fund. But nonetheless, if we could get your recommendation on both those funds, so whichever one it is, he can perhaps go forward with it.
Okay, so two questions. He has got confirming the fund and also he wants to invest further amount of money. So one Kotak Select Focus Fund is a large cap oriented fund and it's a very good track record of performance, and he must stay on with that particular fund. Kotak Mid Cap is a mid cap oriented fund with little over average performance, and however, if he is looking to allocate additional monthly investment in the form of SIP, and if he is already investing in this fund, then he should continue. There is no point changing lanes that way. But however, if he is willing to allocate fresh amount of money, then what he could do, he could allocate between ICICI Value Discovery and a Franklin India High Growth Funds and allocate this SIP of 40,000 rupees additionally every month.
All right. Thanks, Tanwir, for that. That's Vijay Kumar. That's your answer from Tanwir. But with that, let's wrap up the show. Tanwir, pleasure having you on the Money Show. But do send in your questions. Keep them coming in. We'll get all of them answered on the Money Show. Thanks for watching.